Good evening, everyone. Good evening. My name is Ksenia Lukic, and I am the Group Head of Events here at Vault House Group. I just wanted to say, first of all, welcome and thank you all so much for coming to tonight's Market Matters event. And I just wanted to say thank you, first of all, to Sean Hickman and the rest of the Market Matters team for having us here, for bringing you all together and bringing together the Market Matters members and also our Vault House Group members as well. We've also got our owners of Vault House Group here tonight, John Layton, who is just up the front here, and Vonnie. I'm not sure if she's... Oh, there's Vonnie as well. So thank you all very much for coming. Vault House Group really is by members, for members. Tonight's event, Sean, James Carter, both members of our wonderful collective, and we've got two venues at the moment. We have Berrima Vault House down in Berrima, which is kind of your country estate, is your home away from home, and we have Clarence Vault Rooms, which is your city pad. Now, we are having a number of venues opening up again next year, so if you have any interest in membership, please get in touch with John, myself, or Jake is also around, who is our Group Head of Hospitality, and we'd be delighted to talk you through all of the membership benefits, one of which is a Market Matters membership. But tonight we have the wonderful David Koch. Koshy is going to be hosting us this evening, and I would love to bring him up on stage. Hey. Round of applause.
Thank you. Hello, everyone. It's going to be a fascinating night. Thank you to the Vault for having us here as well. Let me bring up the panel straight away. Ben Clark from TMS. Come on up, Ben. Marcus Padley from Marcus Today. Come on up, Marcus. Marcus and I are adding a bit of a tone to the evening as well, aren't we? Best dressed, absolutely. And James Gerrish from Market Matters. Come on up. All right, have a seat, gents. We're going to talk about all things investing, portfolios, shares at the moment. I'm going to quiz the blokes about some tips for us all. That's the beauty of being in the media and being a necessary evil. You get to interview these sort of people and pick their brains and pinch their ideas and use them yourself. So that's basically what tonight is all about. I'm going to interview them, then we're going to have time for questions after, which I think is probably the most important part of the whole night. If you've got any questions, any stocks you want the guys to run their eye over, just let us know. But first up, let's set the scene. How are you feeling about the market at the moment? Marcus, how are you approaching investing your portfolio at the moment?
David, we've got a policy of not predicting anything. Might sound stupid, but I think a lot of this industry is based around trying to make grand predictions that can't be made. And as far as the market's concerned at the moment, we sat for 120 days in cash until 3 weeks ago, till after that Fed meeting. So now we've got a strategy portfolio that just does ETFs. So now we're fully invested from cash, and we will.
So in 3 weeks, you went from cash to fully invested.
Yes.
Wow.
Okay. So this is possibly where I stand out from a normal fund manager. Normal fund managers can't go to 100% cash, and our portfolio is hypothetical. So we're guiding our members, a lot of whom are over 60, and trying to time the market through an ETF portfolio. So this strategy portfolio, whilst the market is up 1% this year, the strategy portfolio is up 26%. So I stand for you can time the market. Right. And I think I should go on a roadshow which says you can time the market. And the reason people think or say you can't time the market, it was an academic study done in the 80s, is that everybody in the finance industry doesn't want anybody to do anything after they've initially bought their fund. So if you're a financial planner, you've got people ringing up saying, right, are we selling the market now? Are we buying the market now? Should we buy BHP, sell BHP? Your business becomes untenable. And so the industry grabs on to this academic report which says you can't time the market. And clearly we have shown that you can. We did the same thing in the pandemic. We sold on February the 24th, but back on March the 24th. Got 20% outperformance in 35 days. And that is through an ETF portfolio. And that I believe, is a passive way, a low volatility way to get a good return on a big nest egg. And that's what I'll try and do in retirement.
Right. Okay.
Time the market.
All right, so you're back in the market. Obviously, you're bullish for the foreseeable future of the market. Have you gone from cash to fully invested?
No predictions.
No.
But
have you got a feeling in your waters?
As all our members know, the best you can do is wake up every morning and make decisions based on fact rather than decisions made based on guesses.
Okay.
So we will wait till we wake up in the morning and go, this has all turned horrible, and get out.
All right, James, how are you approaching it?
I'd say markets are not about guesses, they're about probabilities. So over time, markets typically go up. The ASX will deliver you 9-10% a year. We're not about just getting that 9-10% a year in terms of markets. If I think about what's played out in the last 12 months, so calendar year to date in 23, the ASX is up about 3.5% when you include dividends. Not a great return in any stretch. Not a bad return when you think about what interest rates have done over that period. We've gone from money being free to money now being, the RBA cash rate at 4.35. 10-year bonds are gone to 5%. They're now back at 4.40. So if you think about, we're not about going to 100% cash. We're not about swinging 100% our portfolio.
Because the market's going 100% cash, was getting 5% in term deposits.
Yeah,
I don't want to interrupt, but the difference is my portfolio is hypothetical. James is running actual money.
Yeah,
He can only go to what, 30% cash or something. Otherwise, whoever your responsible entity is would shut you down.
Well, the reality is, I guess, that you can't, I'm never 100% certain the market's going to go down, so I'm not going to be 100% in cash. Yep. I'm never going to be 100% certain the market's going to go up, so we're going to save some, flexibility in our portfolios. And I think, from a broad context, asset allocation is important. So you've obviously got your equity sleeve. I said the ASX has done 3.5% this year, but international equities have done a lot better. The S&P 500's up 18.5%. Our international portfolio has done 25%. You can get 6% in a government a major bank bond, and now you can get 7.5% in a Westpac hybrid. So, if I think about next year, then I think about a pretty a good landscape for investing. There's plenty out there that should entice investors into consistently well-structured portfolios, and we're going to dig into some of the major themes tonight around what will drive those returns over the next decade.
Because the S&P 500 performance was really driven by 7 stocks, wasn't it? Big tech.
Mag 7. Yeah. But there's fundamental reasons for that. So these aren't just 7 stocks that have been bid up on investors' whim. No. These are stocks that are growing significantly. Their earnings are growing significantly, and we've got some huge changes in why that's the case that we'll get into, no doubt, Koch.
Yeah, absolutely. Ben, how have you been approaching your portfolios?
Well, I kind of take an opposing view. I'm a long-term optimist on Australia, and I think if you look at Australia, we're the fastest growing Western country in the world. We're growing at about 2% population growth per annum, which is about 3.5 times faster than the United States. And you look at most Western countries globally, their population's in decline, and it's a big source of economic growth is population growth. We're the second wealthiest country by household after Switzerland, if you include super funds. And we have an incredible wealth of minerals and agricultural assets divided by a very small number of people. So there's always a lot of pessimists about Australia, it feels like, but I think the golden ride that Australia's had continues, and For that reason, I think I would take an opposing view to markets, which is you want to be fully invested. You need to look through short-term volatility, and I guess keep your focus on the long term, but long term be bullish. Don't get talked out of the market. For 2024, it's going to be an interesting year. I'm looking forward to 2024. I'm bullish 2024 because I think it'll be the first year in 4 years that every CEO I'm listening to is not talking about the COVID impacts on their business. We get a first year of normalised earnings and not cycling against weird earnings. So I think that's good. That's a tick. And it's the first year after the last couple of years of craziness with these rate hikes that we get a stable interest rate environment. So for me, the market comes back to quality. Despite what I said about the long-term outlook for Australia, I think it's going to be a difficult couple of years for the Australian economy. And you want to be in businesses that can grow their earnings sustainably. That trend that we saw from 09 to 19, I think that kicks back in again.
Okay.
Good quality companies, I think, rise to the fore in 2024.
Yeah, just to back you up with the whole migration issue, Australia is one of the only countries in the world where the population is getting younger because of migration, which is interesting. Everyone talks about ageing populations around the world. Migration is skewing us younger. So, James, what are some of the themes that are going to be on investors' radars next year? We've sort of seen the start of it this year, AI, energy transition. Any other themes that you see coming through apart from those? We'll deep dive into those in a tick.
Oh, I think they're the main ones. Koch, you've touched on it there. And I mean, if you think about AI, it is a huge shift in the way we're going to be doing things. It's going to have ramifications right across the economy. I think that the energy transition is going to be a huge amount of money required to get to net zero when we need to get there. Corporates in Australia are very much incentivised to be working towards this. Obviously, governments are, and there's a huge amount of money going into this area. So I think from the mega trends that we'd like to talk about, those are the two big mega trends. But I guess I'd circle back to my points earlier around investment choice. So when you've got interest rates that have risen from ridiculously low levels, the cost of capital being nothing, then it's going to be 24, I think, to Ben's point, and I think he made a really good one about the index is what the index does, but that's not how people should invest in the coming 12 months, 24 months. It wasn't the way people should have invested in the last 12 months. I mean, if I think about our growth portfolio, the index has done 3.5. That portfolio has done 13, but that outperformance was harder to achieve when interest rates were low. So that outperformance is easy to achieve when not all boats are rising as one. Low interest rates, they cover up a lot of sins. And it's these high quality companies that are doing really good things, sustainable things. They rise to the top, and that's the environment we're in now. And I think that's the way investors are going to make money in 24, 25, 26 and beyond.
Okay. Marcus, themes for you? AI, energy transition, the two big ones. What else?
We're going to do those later, right?
Yeah.
One of the best opportunities in the stock market come when the market performs terribly. So post-pandemic was fantastic. Post-87 was fantastic. Post-tech wreck was fantastic. So I'd really love to see a washout. And where there has been a washout, well, we're in cash when we want to be. So the moment it starts to happen, we'll be in cash again. So we're looking for great opportunities. One of the opportunities at the moment, I think, is in Australian financials. Not banks. Banks are very boring. They are income stocks, some of the best income stocks in the world. Resources are struggling with China's economic growth slowing down, and China's trying to hold it up, but it's obvious which way it's going. I think resources are long duration trading stocks. You don't invest in them. Too volatile. But one of the turning points I would like to see is in financials. And any fund manager will tell you, any newsletter writer will tell you that we have had the market going sideways to down for 3.5 years, and no one's making any money. No one's spending on advertising. Trying to get new investors, not new investors, well, if you're a funds manager, it's hard. And they've cut back on their advertising. Trying to get new subscribers to a newsletter is hard. We're at the pointy end of enthusiasm. And there will be a fantastic moment when the stock market takes off, and you won't have to, you won't need a brain to pick the stocks that are going to do well. It's all the stock market stocks. And the most obvious one would be Macquarie, for instance, which is just trending down at the moment. But at the moment, the financial sector is in a malaise, and I wait for...
Insurance has done all right, has it?
Insurance has only done okay because stocks like QBE are well known for holding huge bond holdings that do well when interest rates go up, and they'd be a sell at the moment because interest rates started to go down. But at some point there will be a fabulous opportunity to buy financials as soon as this market takes off. At the moment it's not taking off, so we just sit and watch.
Yeah. Ben, any other themes for you apart from AI, energy transition?
Look, I think the other one is healthcare for me. If I was sort of calling out an area, I think that's good.
Ben, who's done their shirt on CSL? You know? Yeah, overweight CSL, it's gone down to 230. You can't buy any more because you're overweight and average down.
Yeah.
ResMed, shocker.
At least you'll be skinny, Koshy.
Fisher and Paykel, horrible.
Sonic.
We could keep going. My
Helios.
God.
Don't get me started on Helios.
Come on.
David, you are being the herd.
Yeah.
Okay? You've got to watch the herd, not be the herd.
I know.
So
CSL's up 12% in 3 weeks.
I know.
Healthcare has been the worst performing sector 2 years in a row, and that's never happened before in the Australian share market. So you think that there's got to be some mean reversion there, and there's a variety of issues.
So what, led by the CSLs, ResMed?
Yeah, I mean, so going back to what I was talking about before.
Cochlear's done it right. Yeah.
Cochlear's done well. Yeah. Going back to what I was talking about before, CSL and a number of these stocks they've had these weird COVID bumps, and then they've cycled against them, and then they've had a lot of knock-on COVID issues. So, a more normalised environment, I think, sees a return to a more normalised earnings growth level. And then you've got this freak trade about GLPs or the obesity drugs, Ozempic mainly. I caught up with a friend who works at ResMed, and she was telling me that she believes this reached a fever pitch when they saw JP Morgan upgraded US aviation stocks because they believe that they'll need less jet fuel going forward because the weight on the planes will be low.
Because Americans all of a sudden are not going to be fat.
Completely.
As a country.
Or carry less baggage.
Oh, my God.
So there's, to me, like, I don't want to discount.
You're making that up.
I'm not making that up. No.
Oh, for goodness sake.
Yeah, so that's where, and I think, for Fisher and Paykel and ResMed and CSL to a very small extent that have been hit by these concerns, these are some of the highest quality growth stocks in our market.
Okay, so it's a target for you. James, let's dig into the big mega trends though. AI first up.
It's a tough one to get your head around and explain, Koshy, but I'd liken it to, AI is about data, right? And the how do you use that data to be more efficient in our lives, essentially. The one major, I guess, similar play that came in recent times was the advent of the iPhone. So you think about the iPhone and what it did and what it actually allowed us to go and do. It wasn't the iPhone itself. It put a computer in our pockets. It was all those millions and millions of smart people out there who designed apps to allow us to get around the city quicker via Uber, apps to find a date through Tinder. All of those apps that came out.
Really?
Speak to yourself. Maybe Koshy was on it.
Maybe. I was post Grinder. Koshy's just put up there.
Been married for 45 years.
So I mean, it's I was post iPhone in the pocket, post Tinder, and it's a. Right. I mean, you think about the lifestyle that others may have lived. But you think about what the iPhone did. It wasn't the fact that we've now got a computer in our pocket. It was all of those apps that went on it that made our life more efficient. And that's what AI is going to do. So it's all about, obviously, data is really important, but it's about what gets done with that data. Yep. So all of the efficiencies that come from the AI revolution. And one of the things that obviously, you think about Microsoft as probably the first mover in this space. So Microsoft's got an AI program around, called Copilot, which it'll take your Teams meetings, turn it into, it'll do the notes for those meetings and send it out to those team members that attended. It'll take your Word document and turn it into a great visual presentation. It'll take your Excel spreadsheet and design, really nice graphs around it. So that improves efficiency. So someone like Microsoft that's got 500 million customers around the world for $30 a month, they can get, they can tap into those efficiencies. You think about, obviously, data, but it's a dissemination of data and how you use that. So the cloud is really important. The cloud is central to all of this. So, you think about, there's probably 3 to 4 companies that control the cloud. You've got Google, Amazon, you've got Oracle is probably a stretch, and then you've got Microsoft, which is the big one in the room. So, you need to be in the cloud, and then when everyone's making investments in the cloud, they need to. Now, there's only one. They go to NVIDIA to supply that. So the semiconductors that power it all. So all of this huge investment that's going into the cloud, and someone like Microsoft, you think about that mobile revolution. They missed out on it completely. They were nowhere on the mobile revolution. They're not going to miss out on the AI revolution. So there's a huge amount of money going into it. You think about NVIDIA, and I won't go on for too much longer, but analysts, this is one of the top 10 companies in the world. 12 months ago, analysts thought they were going to do $1.25 earnings in 23. That's 300% off the mark. Yep. There's a lot of smart people being paid a lot of money to analyse these companies, and they're getting it so wrong because the spend is so big in this space. So AI is here, it's going to grow. And there's going to be a lot of different ways to play it, but the big will probably get bigger in the space.
Marcus, what's your view on it?
I think AI is insulting. I got an email the other day from a guy who's doing some marketing for us, and it said, "We really look forward to accelerating your sales!" Exclamation mark. Like, mate, you used AI to write me a fucking email. And you're supposed to be the brains. And I do think the whole thing is overhyped at the moment. We're clearly in a bubble. You've got a price to sales ratio on NVIDIA of 40 times. Do you know what that means? That means NVIDIA has to pay us, without any costs at all, has to pay us all of its sales as a dividend every year for 10 years, for 40 years before you get your money back, right?
Just countering that, Marcus, and I'd hate to jump
you go
in
for
here,
it,
but if you think about their earnings, so this year they're going to do about $4.60 earnings a share. Next year they're going to do about $13 a share. They're on 25 times next year's earnings.
Right. Thank you, James.
Sorry.
But I still think we are in a bubble of the mere fact we're chatting about it suggests to you that we are in a moment of hype. And if you look at someone like Google, they have to get into it because it's going to bastardize their search business. And now they're developing their own chips to get rid of NVIDIA so they can do it cheaper. And there are most of these companies trading at 5-6 times price to sales. That's quite normal. But Microsoft now up at 11, NVIDIA's up at 40. So we've got a bit of a bubble going on. All we've been doing is trading FANG, which owns all the top AI stocks. And we've also traded the NASDAQ. In fact, if you look at Australia, Australia's a backwater this year. The only trade has been buying AI. The only easy trade was buying AI earlier this year, and that seems to have peaked out. It's going to go in investment cycles. I don't think it's about us predicting what the future is. It has to be backed by earnings. Prices are overpriced compared to earnings. So I don't think you make any long-term judgments.
Okay.
But if I had to buy a stock, it would be Microsoft when it comes back.
Okay. All right. Ben, you wouldn't buy Appen? Appen was our local AI company for years, wasn't it?
No, I was in the UK the other day, and the corporate finance guys are very busy with data centres. So NextDC is about the only data centre, the only AI investment here.
Or Goodman now.
Yeah. Ben, what's your view on it? Are you somewhere in the middle between James and Marcus?
We own Amazon, Microsoft and Google, and we have since 2019. Jeremy, who I work with, and myself, we went over to the Berkshire meeting, and then we went and saw some companies in New York. We went to this thing called the Tech Day, which was down in Hudson Yards, and it was like an expo centre the size of 8 football fields, apparently. And like, to be honest, it was like an infill day. We just thought we'd find something to do. And Jez and I were wandering through this, and it was just store after store after store of small, micro, big, everything in between businesses pitching for capital, workers, partnerships, everything you can think of. And I remember we went and had a drink after, and we were like, that was just insane. And then we sort of worked out that the only asset that these businesses all own is their data. And since then, what we've seen is like a linear progression of the demand for data storage, but it's now going to go exponential. And that's an inevitability. There's only going to be 3 data storers in the Western world forever, I think, because the infrastructure spend's so massive. So I think there's still a great long-term story there, but I would agree it's probably in the short term a bit overhyped. But you know, we've seen hype can go on for a lot longer than you expect.
Okay, so here in Australia, how can you leverage that? What stocks?
Well, one thing I'd just say is that it sort of reminds me, like, if you listen to the experts coming out of Silicon Valley, and they sort of think that AI is more formidable than the creation of the internet. So it is something you need to definitely be on top of. And where I would start if I was an investor is what we saw was that some businesses got decimated as a result of the internet. So it's not just talking about what's the next winner. It's also thinking, I guarantee you there's some stocks in the ASX that get crueled because of AI over the next decade. So I'd have my eyes wide open as to what that could be. I don't think there's any companies that are going to directly benefit from the AI spend that we're seeing globally on the local exchange. But I can guarantee you there'll also be a lot of companies that could get a massive productivity lift as a result of it, new revenue streams created, and this could be the next step in what will give our market that big bump.
They'll re-engineer their business. James?
Yeah, absolutely. I mean, the one obvious one on the ASX that's sort of pivoting into that area, and Marcus alluded to it, NextDC, I'd call out Goodman as a really high-quality company led by someone who is just phenomenal at property, and he's pivoted his business very, in a timely way towards data centres. But the difference between Goodman and a NextDC, Goodman has the sites, they have the capital partners to do it. NextDC has obviously got the smarts around data centre operation, but there you can bring those in. It's easier to bring smarts in to run a data centre or manage a data centre versus having the land, the capital partners to put the data centre on. So, Ben made a really good point about efficiencies in companies. Banks are going to find it really hard to grow at the top line, but gee, they can put some efficiencies in their business. I mean, CBA spends $2 billion a year on tech. The concept that the big will probably get bigger, I think, is from a broad brush investor standpoint, really important. And I don't think, I'm not an uber bull on AI. I just think it's a theme that we really should have our finger on the pulse and understand how each of the companies that we hold in our portfolio, how that could potentially impact on a positive side or hurt on a negative side. And there's a bunch of businesses that you could call out that are going to be hurt by it.
Yep. Who do you think will be hurt?
I think businesses like traditional printing businesses, marketing businesses. IVE Group would be one I'd call out. I think banks will probably be a beneficiary of AI. I think mining companies, which are the banks and miners, the driver of the ASX, they'll probably be beneficiaries. You think about mine planning. You think about all of the friction points when you're running a mining company. AI, autonomous vehicles, all of those things, the move towards EVs in mining trucks and all of those, new age things are going to drive efficiencies in the cost of production and the returns that we get out of those companies.
Okay. All right, and just a bit of trivia. Data centres spew out more carbon than the global airline industry, to give you an idea of...
Before or after Ozempic?
Yeah, exactly. Which leads me to energy transition. Boom, boom. How big a theme do you reckon that'll be, James? And where we are, all of the AI stuff is going on overseas. Here in Australia, we're big beneficiaries of that, aren't we?
We're going to be huge beneficiaries, Kochie, of the energy transition. Obviously, there's going to be some companies, like Ben alluded to before, that don't benefit from it, but there'll be a lot more beneficiaries of this energy transition. At the end of the day, all companies are moving towards, they're moving towards net zero. So, BHP by 2030 is going to be net zero. All of the companies out there are moving towards a similar sort of target. There's ramifications in terms of the huge amount of demand for raw materials that will get us the energy transition. So you think about copper in that regard. You think about, if I think about commodities, they're either supply, the prices are either led by weakening supply or rising demand. So there's things like old world coal will be, I think, supported because the supply side is going to be really low. But then you think about copper, the demand side is going to drive that over multiple decades. So, I think it's huge. There's about $4 trillion a year that needs to be spent globally on the energy transition between now and 2030. That's a huge amount of money going into that area of the global economy.
Yep. Marcus?
It's coming. You can be as sceptical as you like, but it's coming, obviously. And but it has to be paid for by government. It's not, I don't think, an area for private investment. I don't think it's an area, therefore, it's not an area for listed stocks to succeed at. What was that geothermal company that absolutely did its nuts, and every investor's nuts in Australia as well? Do you remember what that was called?
Don't own stocks that go down, Marcus.
But it is clearly coming, and the money has to come from government because it's massive. And I think it's a little bit like NVIDIA. The companies that are going to make money are the people who build stuff, not the people who are using the energy or are going to benefit from cheaper energy. And so who builds wind farms? Who approached I was on a motorcycle tour with a farmer who's been approached to put 80 wind farms on his farm, and he's, yeah, I'll do that. He gets paid whatever it was, $800,000 a year for each one. Who builds those? I don't know, but there's not an obvious Australian company at the moment that does all that infrastructure. Yep. But the only stock I could think of is what's the most used renewable energy at the moment? Hydro, 18%. What's the second? It's actually nuclear. And you've probably seen in Europe, they are designating, some countries are designating nuclear as green energy. And you've probably seen Paladin, which used to produce, rising. And if you look at the numbers, it'll be back in production by the first quarter of next year. Look at the number of nuclear power stations in the planning stage and being built. There's no new uranium production. And they will be in deficit, and Paladin's the most obvious player. So I would say if you've got to pick a stock, Paladin. Otherwise,
Paladin Boss is the other one everyone likes, and then BHP just has to flick the switch on Olympic Dam, does it? The world's biggest uranium mine, which is in mothballs at the moment.
absolutely. I mean, we own Paladin. Like it, I think one of the other obvious stocks that Market could allude to was Worley. I mean, they've now got 40% of their business exposed to decarbonisation work.
Yep.
I mean, they won't build the solar.
That's actually a good pick, James.
They won't.
Hang on, I've just got to get my mobile phone out. Get on to ComSec. Forgot about that one.
No. Well, Worley came up on the call the other week, and I was surprised they'd skewed their business so much to renewables.
It's been a crap business for many years, and
Business.
they've been involved in the old school maintenance of old school energy assets. They've been making a 4% margin, but they've got now a pathway to be making 9-10% margins on a big pool of work, a big revenue mix, and a growing revenue mix because of our big push to decarbonisation.
Ben?
Yeah, I think every council, city, company is signing up to zero carbon. It's going to happen at different paces in different countries, but it's an inevitability that the planet is now on the same path. I kind of disagree with Marcus in that I think there will be a real cost to consumers and business. I think it will lead to higher energy prices, and it will have knock-on effects, and governments are not going to be able to afford to bear the cost of it all. Hopefully it's for the greater good. But in terms of stocks, I think we've seen a 70% fall in the lithium price this year. And I think that kind of highlights to me, like if you look at the AI mega trend, I think that's going to happen very quickly. It's things are speeding up exponentially in tech. The decarbonisation theme is going to be a long-term burn, I think, sort of multi-decade. And there's going to be lots of cycles throughout it. And I think you want to be thinking about picking up things that are going to benefit from this long-term thematic when they're out of favour. So, Australia now produces 50% of the world's lithium. We're the largest provider of lithium to the world because we are very good miners as a country. We've got great technology.
And we are the Saudi Arabia of uranium, aren't we?
Completely.
Well,
so
a long shot.
Yeah. So I think we tend to look for probably lower risk ways to play this as opposed to the direct stuff. So MinRes, we've spoken a lot about, but it's got a lot of iron ore exposure, which is $136 a tonne. Sol Pats, I like coal as well. I think coal is ring fenced, and we're still going to need a lot of coal over time. And Wesfarmers is one that doesn't get a lot of talk, but it's about to bring.
They never talk about that. They always talk about Bunnings and Officeworks. They never talk about their lithium asset, which is huge.
It is. I'm here to talk about it today, and it's there. Not that I work for Wesfarmers, but
you're clearly long and wrong at the moment.
Well, $1 off its all-time high, Marcus.
It's going all right.
It's going okay. But this is the 7th largest lithium mine in the world with a 40-year mine life out of West Australia. And the other thing I'd say, not that I'm some raging lithium bull, but we have an unnatural advantage here because we are a member of Biden's Inflation Reduction Act. And this means that Australian lithium is bought with subsidies by US and key partners. So, we have this unnatural advantage over Chile and Argentina producing. And we're very good at producing minerals out of the ground. So there's some ideas.
Okay. All right. Your questions coming up in one moment, but let me just cover traditional foundation sectors of most retail investors here in Australia, supermarkets and banks. Marcus, you talked about banks a bit earlier. You wouldn't go near them at the moment. Supermarkets?
No, Koshi, one of the things I think we all do is talk generally about these stocks as if everyone would be an investor in them. Okay, there are groups of stocks that are only suited to certain types of investor. I've identified 5 types of investor. One of them's your income investor retiree, looking after a nest egg. Another one's still earning, trying to grow the nest egg, and then there are others. One I created all on my own, which is market timers, right? But you talk about banks, brilliant for the income investor trying to preserve their nest egg, but they're not growth companies. They're sideways companies. They have de-risked themselves a lot now. and brilliant if you're just trying to earn an income. Woolworths, Wesfarmers, they've been going down oddly, and there will be a great opportunity.
It's in my little super fund, and I'm quite happy with it at the moment.
I'm being a bit short term for you there.
All right.
Looking for a buying
This
opportunity.
afternoon they went down.
But they, thank you, James. But those are reliable. Quality means reliable. Those are reliable businesses. They'll be around for ages. CSL, ResMed. And all those are buyers at the right price for the boring style investor who is long term. So you ask about the traditional areas, and you're talking to a particular group of investors.
Right.
So for that lot, all those stocks are absolutely fine. You want to look for the right time to buy them if you don't hold them already. CSL might be a good time now, ResMed, but banks, look at them. Put 0 on the scale and see what they're doing.
Yep. James?
Well, I think what 2023 has shown is that there's a huge amount of, we talk about sectors, but there's a huge amount of divergence within sectors of companies that have done well and are going to continue to do well, and those that haven't. So, banks are a case in point. So if you think about the banking sector, calendar year to date is up about 4%. You've got ANZ up 10%, and you've got Bank of Queensland down 14%. That's nearly a 25% differential between the two. CBA's second place, they're up about 5%. Tech is really important in banks, and that's how they're going to drive efficiencies, and that's why CBA trades on 18 times versus the other banks on 12, 13 times. CBA spends $2 billion a year on IT. Bank of Queensland spends $140 million on IT. Who is going to keep up in this race when banking is going to become a tech-driven area? If you think about Woolies and Coles, Woolies is up 5% this year. Coles is down 5%. Wesfarmers, for all their, for as well they've been doing in the last 12 months, they did a shit job in Coles because they didn't invest in the business, and we're seeing the fruits of that underinvestment now. So Woolies has invested in supply chain. They've invested in their digital marketing capabilities, their smarts. And when you see inflation come through and the cost of everything go up, you see Coles margins really get pressured because they can't respond to that, whereas Woolies could. And that flows through in the performance of a stock. So I think it's a case this year, and I'd pull it back to the points I made earlier about active approach to the market. I mean, it's not investing in an index. It's trying to pick those companies that are doing good things and will continue to do good things. It's finding the companies that have got a track record of doing them and are investing as they should be. I mean, Qantas is another case in point around a guy that really underinvested in that business to push up short-term returns to fill his own pockets. I mean, that will come home to roost in the next 5 to 10 years for that company. So our job isn't about saying, banks are a buy here, banks are a sell here, or supermarkets are a buy, or vice versa. It's about picking the good companies to own. It's about understanding those companies and the drivers that will propel their earnings and therefore their share price higher, and not taking huge bets either way on what will happen tomorrow on the market, but making those educated bets based on probabilities in the medium term.
Ben, those traditional sort of retail investor darlings, supermarkets and banks?
Yeah, I don't think I can add. I think there's a lot of good advice there. I think the banks are probably fairly priced. I think the outlook looks tricky for them because I think there's going to be a lack of credit growth and the margins are still under pressure. There's a full-scale pricing war still happening, and to my mind, Commonwealth Bank is a winner in a pricing war because if I borrow $1 million from Commonwealth Bank, $650,000 comes from your cash and they borrow the difference. And for the other banks, it's the opposite. They have to borrow 2/3 of my mortgage in wholesale credit markets. Woolies, I think, has done a great job, but it's low growth and it's expensive. But, just going back to what I was talking about at the start, Kochie, there's 500,000 more people here that will all inevitably be customers of Woolworths. And that's what I was kind of alluding to is population growth most companies on the ASX will benefit from that. And but you know, on what, 23, 24 times, I'd rather buy Nvidia probably if they're trading on the same PE.
All right. Hopefully that gives you a bit of guidance on what the panel think about some of the big themes going forward. Happy to take your questions now. Yell them out if you've got any questions on sectors or stocks. Yes, mate.
So retail sales were soft today, but anecdotally I've seen all the packages arriving at home this week, and driving around last Saturday was very busy. What are your, we obviously think rates are going higher, what are your high conviction calls on asset classes or stocks? Or
Two parts of the question there. Are interest rates going to go higher? Do you think they're going to go higher? And who will be the beneficiaries?
I think it's a coin flip if there's one more, but I think we're at the peak of rates. And
January 29 is when the December CPI figure comes out, which will be pretty important.
I struggle to see them doing anything in December, maybe February's live, but I think that'll be it. So, but I think the environment kind of gets tougher next year economically, and my personal view is you want to be a bit wary of companies that are exposed to the economy or the consumer next year, because I think it's going to dawn on everyone that rate hikes have stopped, but rate cuts aren't coming anytime soon. And Bullock, I think, has turned out to be probably much more hawkish than Chalmers would have liked her to have been, and maybe he should have kept the previous governor there. But
Bill in there, because I was stunned. Michelle Bullock said Australia's cashed up and they built up a lot of savings. Well, they did, but those savings have been depleted and they're now below average, aren't they, James? So
Yeah, they have.
I was stunned she made that comment and didn't understand that.
Yeah, absolutely. In terms of where interest rates are expected to go, so in the futures market, the 16 basis points of tightening priced in over the next 6 months, so pretty much nothing. If you look at bond markets in the US, they're down about 60 basis points from the highs. In terms of retail sales, I mean, I'd follow Anthony Scali out the door. So, I mean, he sold $50 million worth of stock last week. That's probably not a bad move. I think it gets tougher from here, and there's a lag between when rate rises really impact your ability to spend discretionary, and that the lag effect is conditional upon how much buffer you've got, how much savings you've got. So they've depleted. So I think that lag effect has probably been the retail stocks have been more resilient than we thought they would be, but I think they're probably that's going to be you're going to be swimming against the tide in that space in 2024 would be my my guess, Marcus.
I thought Michelle Bullock is quite a revolution, really, in that she is telling it as it is. And if I had $1 million mortgage, my heart would have sunk to hear her say that we have seen inflation come down from whatever it is, 8.4% to 5.5% in 9 months. But to get below target is going to take 2 years because of the hairdressers and dentists. Which basically she was saying service industries and wage costs. So we've got our own domestic-driven inflation problem. It's 2 years. So she's effectively told us we're not going to see interest rate cuts for 2 years. No. And if I was sitting on an 850 grand mortgage, which is what some dickhead financial planner told my daughter to take out the other day, to buy a Queensland property off the plan, then I would be in trepidation because rates clearly aren't going to come down. I think there's a real risk that Australia misses out on the peak rates party that's going on globally, that started in the States a month ago, and consequently, I wouldn't have any conviction about the three sectors that could move, which is basically retail, consumer discretionary, housing, and financials as well, finance market, because it's not going to be good for banks either. Yeah. Lending growth isn't going to grow in this environment. So it's a real downer for Australia. So consequently, I'm still happy to play around in those ETFs that give us exposures outside of Australia.
Okay. Just speaking as a dad, did your daughter follow your advice or the dickhead financial planner?
Well,
Usually the kids don't follow our advice.
Koshi, thanks to DocuSign, she was 3 clicks away from committing to
Right,
that.
okay.
So, AI is a nasty piece of work as well, because it's allowing my daughter to get trapped by a Queensland financial planner in 3 clicks.
Off the plan, blimey.
Yeah, he'd still be a dickhead.
Okay.
She said, I want a dog and a flat in Melbourne, and that's what he came up with. She just needs a dog and a flat in Melbourne.
All right, next question.
Over here.
Yes, I wonder how the team thinks about Telstra, please.
Telstra. James, do you want to kick us off with Telstra?
Telstra today, I think, made new lows for about $3.75, I think, if my memory serves me correctly. We own the stock. I think, there's a couple of things that are going to feed into Telstra over the next little while. So population growth is one. They're not... The combination of what Telstra owns, so obviously they sell NBN, they sell phone plans, etc. But I think the market, why it's dropped over the past sort of 6 months or so, has been a disappointment around the lack of sale of their infrastructure business. So there was quite a number of larger shareholders pushing for the sale of InfraCo. They did what was needed to be able to spin that out, but that hasn't spun out yet. So, I think down here it represents pretty solid value. We own it in our income-focused portfolios. We don't own it in our growth portfolio. Sean's been pushing the buy in the growth portfolio. I still don't think that stacks up, but it's down here at 375. I think it makes sense.
Okay, Telstra is a good buy. I remember one of their key executives told me in July when they put their mobile prices up 7.5%. I said, why have you done that? Have your costs gone up 7.5%? Well, no, we put the price up because of inflation. And I said, no. Have your costs gone up? Well, inflation's gone up 7.5%. I thought, not the question. Usually tech efficiencies come through and don't mirror inflation.
And they never put prices down.
No, exactly.
So therefore,
Well, Ben, what's your view on Telstra? A buy as well?
Don't own it. Look, I think it's, for me, it probably looks cheap. I guess these businesses incredibly sticky. Like I saw some data the other day at how few people had left Optus after the shambles that's happened. It shows just the stickiness of the customer base. They do have a bit of pricing power, and I think there has
They'll
been...
benefit from AI, though. Would they be a company that you'd say would...
You'd think that we'd all continue to use more data, and that... If we're in a rational pricing environment, and you remember we went through a very, similar to what the banks are going through at the moment, when TPG was really shaking things up, if the rational price environment holds, then these businesses should be able to keep growing their earnings. I can't buy it.
Okay. Marcus?
Very quickly, James nailed it. It's you buy it when it's yielding over 6%, which it got to the other day. It's an income stock. You wouldn't trade it. It's not a growth company. You might trade it for a slow 10%, 20% if it got itself nailed. So
okay.
buy on weakness.
Yep, and it's
yawn.
weak. All right. Next question.
Hi guys. Question around Pilbara. 20% short today. What do they know that Gina doesn't know?
That's a great question, because what's happening in the lithium market at the moment is bizarre, where the guys that have managed to get through to production, and they spent way more than they thought they were going to, and it's taken way longer than they thought they were going to, but they're now going to be in production for 20, 30, 40 years. They've done all the hard work. They're so weak. And then we're seeing these incredible prices that Gina and Chris Ellison are paying for companies that are miles from going down that path. So it's got me quite confounded, actually, because I can't quite work out how that matches up. We don't own Pilbara. The shorters have had a field day, and I think, they've seen in the past that when a lot of lithium supply comes to the market, we're seeing a small step change in demand each year, and it's inevitable. It's just going to keep going, and there'll be periods where the demand overtakes the supply, and there's going to be periods where the supply overtakes the demand, and we're in one of those periods at the moment. And I think that's where the shorts are. It's liquid; they can get out of it.
You wouldn't
easily.
get into it now?
Look, I mean, we're in MinRes. We've got Wes Farmers. We're happy with that.
Yeah, James?
So we don't own Pilbara. The only, like Ben, we've got mineral resources in our growth portfolio. 20% short's a huge, extraordinary amount, right? So, large funds are short Pilbara because obviously lithium is expected to be in oversupply for the next 2 years. So there's no respite in terms of the lithium price. What I'd say, lithium is down 80% from its highs. So whenever there's less bearish news around lithium, I mean, I'd be pointing to Pilbara as the one to own. That's a large short position, to cover on Pilbara. I'd be a very nervous short on Pilbara right at this point in time. And Ben made the point around the valuation of their assets relative to what other minnows that are not producing are trading at. If I was looking, if I was a big acquirer out there, I'd be buying Pilbara.
Okay.
They're
But you're not at the
producing
moment.
cash, not now, but
No.
we did a report this morning on the lithium space, highlighting Pilbara as the one we would buy. So we just need slightly less bearish news. We want to see the price stabilise. It started to stabilise, and we want to see it start moving up, and a little bit of pain, so a little bit of short covering start to come to fruition. So they're the indicators I'll be looking for in the lithium space.
I don't think it's about Pilbara at all. It's about lithium. I think some large hedge funds have just shorted every lithium stock. I'd love to see what the short positions are on the international lithium stocks as well. It's just that Pilbara's one that they can short here.
Yeah.
And they clearly think it is still overpriced. There's still a lot of sentiment in lithium. It's unwinding. It's like a fad unwinding. It's like BNPL unwinding. And it's got further to unwind. But of course, one piece of good news, manufacturer from somewhere, you'll see a huge rally, won't you? But it won't last if the lithium price keeps doing that. So I just look at the lithium price, and as long as it's doing that, I wouldn't touch any of them.
That whole EV type thing, are there other ways to play it? I was at a lunch the other day, and this bloke told me he'd bought a chain of tyre retailers, because he said EV vehicles are twice as heavy as a normal vehicle, and they'll go through tyres quicker. And I had no idea whether he was right or not, but I thought, oh, that's a lateral way of thinking about it.
I think that is true, and the taxation that they're musing to put onto EVs around Regio, etc. Because of the wear and tear on roads.
I thought that was smart. Thinking.
The problem will be Tesla will probably launch their own tyre. I would have thought, like, point. Elon doesn't miss those sort of things.
No. Next question.
Just over here.
Gentlemen, in terms of local Australian AI plays, Marcus mentioned NextDC data centres. There's also a company based in Queensland, I believe, called Megaport that has quite a unique business model in that regard. Has anyone got a comment there?
I don't know. I'll take that. I don't know Megaport, which is one of probably the most divisive stocks on the stock market. I reckon you get 3 different answers out of 3 different people. But what I would say is I'd be really wary of Australian companies that are trying to hitch their wagon to this global AI thematic, because I think I don't think there's any companies really that you can truly play the AI theme in Australia. And I think even if you look at America, the vast bulk of the companies that are going to harness most of the AI spend are going to be private companies. They're not publicly listed. So Goodman Group, for me, I'll back up James there. We own it. We've been buying more of it. Greg Goodman is a freak, and if you see what he's done in industrial property and what he's calling out that he thinks he can do in data centres, that's the one for me.
Yeah, Megashort. It's super volatile, and I don't get comfort in the way they articulate things to the market. So it's not one we own. I think I like the idea around what they do. So they're allowing to up spec and down spec connectivity. So I like it from that respect, but I think their valuation relative to what they're doing is pretty stretched. I think Ben made a good point around companies talking about AI into their place. I mean, Xero, for instance, so they've got some AI capabilities, XRO. It's not going to be a huge driver of their earnings, but they'll be able to, they can tell you where to improve your cash flow, etc., when to invoice, how to invoice, and expedite that process. Lithium is a stock that we own. They are in the design of printed circuit boards, so pretty high-end tech. If you think about how they're utilising AI, I mean, they're looking at AI from a perspective of streamlining codes and regulation around jurisdictions they operate in, but they're not really utilising that for the physical design work in PCBs. So other than that, I mean, Goodman, data, they're the ways to play it. But you think about, so mining is around, a mine, so people go out there and stand on a hole and lie through their teeth to raise money. I mean, that's how I would akin to some of the AI companies out there that are flagging AI as their core business. And then you think about the picks and shovels. They're the companies that are providing the pipes to make this all happen. So it's your Amazons, your Googles, your Microsofts, Oracle to a lesser degree. So I'd be going to the US. There's no reason why Aussie investors can't invest in international stocks, and you've seen this year that it pays to widen your horizons.
Yeah, and they're, as Marcus was saying, some great ETFs. James, you're a very polite person. You don't like how Megaport articulate to the market. In other words, you don't believe a thing they say.
No, I'm a cynical person. I think you've got to be as an investor, and
Yep.
And when
more than the
so
story.
Kochie, if someone came up to you and told you something once, they told you something again, and then a quarter later they told you something completely different, you'd call them a liar.
Yeah.
And that happens a lot in the markets. I mean, there's no company CEO out there that won't come and promote their business and tell a story that's really positive about their business. And our job is trying to siphon through that bullshit and get the message that we want to take out of it.
It's a very good point. Next question.
Just up the front here.
Yes, my next question is there an ETF which covers Microsoft, Google, something like that we can invest and hopefully have a good Christmas with?
Yeah, Mark.
Yes, FANG, but and we hold it at the moment.
Military is the code, isn't it?
Yeah,
FANG.
it's
FANG.
FANG, and in Australia, and it owns 10 stocks. It includes all the big AI stocks. But
Have you missed the boat?
I don't know. We hold it. We bought into it after the last Federal Reserve board meeting, just as an interest rate play. It was obvious big tech was going to take off again. And it's all plateaued, hasn't it, over the last 2 weeks? The US has sort of gone on Thanksgiving holiday, and now we're wondering, is it going to take another leg up or not?
Right.
But the mere fact we're asking that suggests that this is a sentiment thing, not a fundamental thing, because the fundamentals are a bit pushed at the moment. So there's no guarantee. I almost sold our NASDAQ FANG, and we've got LNAS, long NASDAQ as well. We've done very well out of all those in the last 3 weeks. We almost sold them today, but didn't. Let's see what the US does when it comes back from holiday. But, NVIDIA is the golden child, isn't it? It's off about 5% since results. It's lost, the momentum's gone a bit. I'd be worrying about selling, not buying for Christmas.
Any other questions?
Yeah, I think we've got one final question over here.
I just want to say thanks, guys. It's been great. I'm interested in your views on currencies. We haven't heard about currency today, and we've also talked about international stocks, Aussie dollar being really weak. How are you thinking about currency and how we should think about that as investors?
It's a really good point. Really good point. Marcus?
Can I do that one to start with? Aussie dollar, if it's ever going to go up, it's going to go up now, because our rates are staying up. US rates have peaked. You've seen it come off the bottom. The whole reason it was going down is because the market was scared of everything. Hence, everybody's buying the a US dollar as a safe haven currency. That whole thing's flipped around. If China actually fired a bazooka, it would fly, wouldn't it? But I do think, there's a good chance. You could have made, there's an ETF, you could have made 12% out of the Aussie dollar move in the last 3 or 4 weeks. And I'm kicking myself because it was an easy, low volatility trade and it was obvious. And it's probably still a buy, quite honestly.
Yeah, I mean, currencies follow yield differentials. So the US, target rate is 5.25 to 5.5. We're at 4.35. The US is now priced in 100 basis points of cuts in 24. So their interest rate's going down. Ours probably isn't. Aussie dollar goes up, which I agree with Marcus. 100%.
James, break the habit of a lifetime.
So if that's the case, Ben, what does that do for your stocks? Who are the big winners and losers if the dollar goes north of 70, 75 US cents?
Well, I'd start by saying the biggest driver of currencies is yield differentials, 100%. But when 3 of us all think the Aussie dollar is going to go up, it's going down, I guarantee it. So I think don't buy or sell companies on the view of what you think the currency is going to do. Buy or sell companies on what the company's doing. And there'll be periods where the currency is a bit of a headwind and there'll be periods it's a bit of a tailwind. But if the company can earn $2 a share today and it earns $8 a share in 10 years, the share price over time will follow it. So don't freak out too much about that.
Koch, it's important to say, if the Aussie dollar was going to 75 cents, then something's happened in China and the resources have shot off. So it would be all resources.
And I actually like the balancing impact of currency on a portfolio. If you've got Aussie shares, international shares, fixed income, etc., when things really struggle, Aussie dollar goes down, your international shares benefit from that as well. So it's quite a stabilising mechanism, and it smooths those sorts of returns. So it's something you should think about from a portfolio construction, at least, having some currency exposure in there.
Yep, and hopefully import prices go down as a result, bring inflation down further. Keep the Reserve Bank happy. Ladies and gentlemen, would you join me? It was a great session, I think you'll agree. Ben, James and Marcus for a terrific session. Thank you.
Thank you, Koch. Just on behalf of Market Matters, the panel, thank you very much, Marcus, for flying up from Melbourne, battling the traffic. Ben, coming from Manly, thank you, mate. And Kochie, thank you very much for making the effort and regaling us tonight.